In this video, we're going to talk about Blackberry, trading under the ticker symbol BB. Blackberry Limited is a cell phone manufacturer and retailer that makes cell phone, emphasizing on security. It was once a must-to-have for office workers and high-net-worth individuals. The company has first struggled in the new era of smartphones before providing again the proof that it is capable of being relevant in this day and age. It has since then diversified into other fields like Internet of Things and cybersecurity. Its appeal to the market is that it is a very well-known name in the sector, has strong brand recognition, and has established presence among individual and corporate clients. It has revenue streams that have become predictable with positive cash inflows, both of which are positive catalysts for the stock to thrive in the future. For those who want to make a balanced portfolio in the electronics or retail sectors, it is often a good company to consider due to its established presence, strong name recognition, and good reputation for users valuing privacy and cybersecurity. The trading volume of Blackberry has recently been 7.5 million shares compared to an average volume of 9.6 million shares. Over the previous 52-week period, its price has been fluctuating between $6.51 and $28.77. The market cap of Blackberry is currently at $5.3 billion, compared to an enterprise value of $6.1 billion. The difference between the market cap and its enterprise value is the premium or discount financial market wants to allocate to the company, based on its current fundamentals, leverage, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back this debt with interest and principals, which in turn may impact its profitability and even solvency. Another key element to understand is the asset composition of many companies, and it is especially true for growth-type companies. For many of those, one of the most significant assets they own is goodwill. Goodwill is basically an expectation that a company is able to do well because it may have a good management, good brand recognition, bigger following online, and so on. In other words, it's not a tangible asset. However, it's often the reason why some companies are perceived of being trading at a discount. In comparison to its historical price fluctuations, the stock is 11.05% higher than its 30-day low. Same goes for the 3-month low, and 43.51% higher than its 52-week period low. In terms of the options market, which often gives a hint on how the market is feeling about Blackberry, the stock price is likely going to head toward. The implied volatility is 63.41% compared to the historical volatility of 40%. A put-call volume ratio is currently 0.29. The most recent volume of options traded has been 44,000 compared to the 30-day average of 63,000. In terms of open interest, the most recent volume of open interest has been 815,000 contracts compared to the 30-day average of 822,000 contracts. When we look at the shareholder structure, institutional shareholders hold approximately 43% of its outstanding shares. The biggest shareholders include Fairfax Financial, Allianz, and Vanguard. The relevance of the shareholder structure is kind of important because this is really something that can help us to determine whether you should hold the stock long term or view it as a short-term volatility play. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Now, of course, there are a lot of exceptions from what I said above, but usually the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Let's also look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, if there are significant short interest in the total volume, it could be a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. In case of Blackberry, though, this is much less the case. So the current short interest is 6.91 of the total float and 30% of the dark pool transactions. Now, let's take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements to determine what should be our overall approach. The oscillators are showing 1 sell, 8 neutral, and 2 buys. Overall, the oscillators suggest an overall neutral tendency. On the other hand, the moving averages over the past has been showing 9 sell, 1 neutral, and 5 buys. Overall tendency from the perspective of moving average is the sell. So the moving average can be used to determine whether the stock is overbought or oversold to its previous price fluctuations, which can be used to see if your trade is sufficiently well timed. In terms of pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $4.27, $7.20, and $8.15. For the resistance levels, they are $9.80, $12.31, and $16.55. Looking at the stock over the past few sessions and weeks, it seems that the share price has been trading within a range of price after significant price movements and is now stabilizing around $10, although admittedly, it is still in a relatively high place compared to where the stock has been over the past 5 years. This is more or less relevant because the company was in a different spot 5 years ago. If our time frame is within the past year though, then it is at a relatively affordable price level. Market participants, and more specifically the retail traders, are attracted by the company because it has decent technologies and business model seems to head and shoulders above its competitors, or at least as far as privacy and security is concerned. This is what makes it a compelling addition to people's tech or retail portfolio. Blackberry used to be one of the major players before the smartphone era, and it is a company with very high and positive brand recognition. This is why I think that market participants are often willing to give it a chance once again, as soon as there are enough encouraging signs that the company is doing well. Right now, the company seems to be having good financial results, which is one of the reasons why the stock has been enjoying some relatively comfortable price levels recently, before retracting back somewhat. My opinion on the company is that I am overall bullish on the business because it seems to have a solid technology and a very strong brand recognition. The business model also seems to be set to be stable and predictable. The valuations may be at a relatively high place if we look at the past 5 years, but it seems to be at a decent place to buy for the short and medium term looking forward. My opinion is to allocate between 3 to 5% of your portfolio if Blackberry shares is something that you're looking for to put in your tech or retail portfolios, and if you're willing to give this oldie another go. The profit target should be between 20 to 30% of the cost basis. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries. But nowadays, it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks, things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.